Hi, this is Pat Moorhead with Moor Insights Strategy, and we are here for another awesome 6-5 podcast on a Friday, as usual, on schedule, except when we don't make it on Fridays. Daniel, how are you doing, my friend?
We always make it, except when we don't, right? So yeah, living the good life, buddy. It's Friday, a big week, kind of a tumultuous week, but a lot of tech to talk about. We're back in earnings season.
We are, and this is an Earnings Palooza Plus episode. And if this is your first time on the 6-5, we cover 6 topics, 5 minutes each, except when we don't and we blather on. We know you can read the news, so we're all about the why it matters. When it comes to earnings, please don't take this as investment advice, because the 6-5 is for entertainment and informational purposes only. In fact, just do the opposite of what we might be inferring or what you might think we're inferring. So Daniel, let's freaking jump in, baby. I've had multiple coffees and I've got my water.
Hey, you're looking good, man. You're looking sharp. You're going to be on CNBC on the exchange. So if you're watching here, put that on the calendar right now, because Mr. Moorhead is going to be talking all these earnings. So you're just getting a taste here of he's getting his practice round. We call this a practice round for the big leagues. And by the way, we're not going to talk about Apple today, but I just feel remiss to not just mention the fact that, I don't know, one of the biggest tech moguls in the world, love them or hate them, and sometimes I love them and sometimes I hate them, had a really good quarter, and iPhones were explosive. But here's a funny thing, Pat, just one little snippet, just because I know we're not going to do a full segment on them. The fastest growing category for Apple this quarter, any guess? Any guess? I don't know if you watched.
Geez, maybe MacBooks.
Mac. Oh my God. What an interesting situation, though. That sort of paints a picture in terms of, is it related to ARM and how well they're doing there? Is it just cycles and related to updates and refreshes? But long and short, my gosh, I've been more than regular in my criticism of Apple, but it seems they're getting something right here now. Long and short, though, what I will say is it's good for the macro economy, and it's good to see a consumer-oriented tech company have such a good result and a good quarter when there's so much Fed tightening going on. I won't give it any more mind than that, Pat, but I wanted to mention it because it didn't make our docket. It's not a company that we advise or work as closely with, but it isn't a company that you can ignore.
Yeah, I mean, once Apple stopped trying to kill the PC as a category and the Mac with the iPad and put an A-team in on MacBooks, it's amazing what happens. People suddenly want all their PCs. So anyways, let's move into, first off, Intel. Intel beat on the top and the bottom, and they were rewarded with a sell-off of pretty epic proportions. Now, what it came down to was a little bit about uncertainty, a little bit of top line softness, but it was really about gross margins. And I really dug into this, Daniel, to kind of see what was going on. And we're going to get a full data dump on February 17th on exactly when some of these costs are going to hit. But when Pat Gelsinger came on and said he was going to double down on capital expenditures, and he's got Intel 7, 4, 3, 20A, and 18A, which are all on that's expensive, right? So what we're seeing are those expenses once they start to get into certain product categories, they hit it pretty hard. Okay. And that's how the accounting of semiconductors go. Let's say, 5% of your mix is on something that you're spending multiple billions of dollars on. Guess what? You've got to peanut butter spread that cost across those, the small amount of processors. And that's kind of where we are. But a couple of things stood out to me. So first of all, everybody's like, oh my gosh, data center group, DCG, something's wrong with it. People are, AMD is winning all the market share. Well, I think AMD is gaining a little bit of market share, but they had 20% growth, which is phenomenal. And then doing a double click on that, 53% increase in enterprise and government demands, which is off the rails. And macroeconomically, Daniel, that says a lot of positive stuff to me about how the economy is going. If businesses are buying a lot of on-prem infrastructure, and that's exactly what this is, right? That's not hyperscalers, which hyperscalers were actually down by 5%. There was this one-time federal charge that I know Intel didn't really want to talk about that much, but I'm speculating this was not hitting dates on a few of these big lab deals that they had. There are penalties that are always involved, and they had missed a couple milestones on that. My last thing on DCG is Intel basically says we ship more Xeons in December than any of our competitors ship data center parts all quarter, with Ice Lake, which is the 10 nanometer, shipping over 1 million units. I kind of like that, a little bit of a flex, right? It's not them saying, yeah, we've got 90% market share, but essentially we shipped, more in a month than everybody else shipped an entire quarter. So taking the gloves off a little bit. I was a little bit surprised on Client Computing Group, called CCG, down 7%, and the core business, which takes out all the wireless stuff, was down 5%. There was a hard comparison in fourth quarter of 20, but even so, man, that notebook decline was pretty big, a 16% decline. I'm super interested to see what AMD comes out with, to see for if maybe it was something had to do with inventory, or it was a share loss. I do believe for this year, I think Intel will gain unit share. I think AMD will likely gain some revenue share. ASPs, right? That's a drill down that I like to do on CCG, which is essentially the pricing power. And guess what? ASPs were up for both platforms. So total, overreaction, I think, on the sell-off. You have to look at the company as a long-term play, and you have to understand semiconductors. This is not like a SaaS play where you can make a price move, increase sales, decrease sales, come out with a new product. These are real factories. These are real tangible things. And a next gen fab takes 2, maybe 3 years to get to get going. But I'm looking forward to the Investor Day.
Yeah, there was a number of things that Mr. Gelsinger alluded to in his remarks. You talked about the client. He did talk about some of the pull forward and pull back that's been related to supply and demand. And so, of course, some orders got pulled forward, and you saw some bigger quarters. I believe last quarter was a stronger one. We saw the same kind of ebb and flow this year with data center, where the early part of the year was really bad, but it was following a really strong end of the year before. So you've had a lot of supply chain related pull forward, pull back, because they're so dependent on the sales of their ecosystem, right? It's the OEMs and how much they're selling, and then of course with all the supply chain issues, it's been how much are they able to manufacture. I thought Ohio was a really encouraging piece of news, and this isn't necessarily related to the earnings, but now you've got the third. So you have 2 fabs in Arizona. You've got the fab in Ohio here, some significant investment. Gelsinger pointed to, he gave an answer that the street, they may not like it, but when you move process, and they hadn't really had a big process move in about 5 years, I believe it was, there's some costs that are associated with that. And those costs are, the trade-off is higher margins and continuing to sell old product. I mean, the trade-off, and nobody liked that trade-off either, right? Everybody was bitter about how long it took them to see Ice Lake surpass Cascade Lake. So, the hardest part about Intel is it feels like the market moves the goalposts on them more than anyone else. It just feels like they get something going good, and then everybody complains. If client's good, then they're going to look at DCG. If client and DCG are good, they're going to find something obscure. Oh, your network group is down. I mean, they will find the thing to not like about Intel, and that's why it's trading at like 10 times forward earnings. When AMD is 40 or 50 right now, and NVIDIA is as well. So it's Intel as a manufacturer is held to a different standard. But I do believe they are the best positioned company on the planet to bring manufacturing here of semiconductors back to the U.S. to help us get out of a future supply chain crisis. And I think they're doing a lot of things really well. The quarter's numbers were good too, Pat. As we headed into what was considered sort of a very negative tech economy, interest rates rising, inflation numbers are high, a lot of kind of hawkishness from the Fed. These were good numbers. The guidance forward were good. You pointed it out. Margin is the most at-risk number right now because it's being compressed, which means they're going to have to do more sales to deliver equal earnings per share. But this quarter they did that, and there's nothing to suggest that next quarter they can't. Their guidance was very close to what the street expected, and certainly with some operational excellence, the potential to beat next quarter exists. So I'll end there because I know we got to get on to the next topic, but I'd say more good than bad, right? If we were looking at that quarter for Intel, more good than bad is a pretty fair assessment.
Yeah, absolutely. And listen, I look at top line pricing and ASP, and pricing power is more important than the cost side. I mean, I know in the end it's about net cash flows in the future, but long term is about pricing power. And if you're an IDM, it is cheaper for you than having to go to TSMC. Intel, in their model, they're capturing both, right? They capture the design value and they capture the manufacturing value. So that's why I'm not concerned. The company still needs to execute. Investors are giving them zero credit for getting into brand new categories they were never in. Discrete graphics for gaming, discrete graphics for workstations, machine learning training with Habana and more, going essentially directly after NVIDIA. Great stuff, great analysis. Let's move to Microsoft, Daniel. And Microsoft pretty much did what Microsoft does.
Yeah, I came out last week. I made the call that earnings this week were going to be really good, and I know maybe that's
big
a risky call.
Big risk there, man.
Maybe there wasn't a big risk there, Pat. But with all of the tech wreck right now, considering 40% of the Nasdaq is down half,
yeah,
you sort of would be expecting the numbers to be bad, or at least guidance to be bad. Like you expected maybe, okay, one more good quarter and then some really bad guidance. And then, the bottom falls out because, the market's forward looking. So the market had already sold because they thought the long-term was bad. It's, the discount rate would be meaning growth slows and the valuations are too high and the multiples on either earnings or revenues were too high. And I guess I just don't believe that that's actually right anymore. Now that we've had so much correction. I mean, it's a little bit of personal interest as someone that, likes growth. But look, Microsoft beat pretty significantly on revenue. And when I say significantly, 51.73 versus 50.8. So, $1 billion above expectations, and then beat on a per share basis at 248 versus 231. The whole story there, though, is Microsoft probably has one of the most robust and diversified subsets of offerings on the planet right now. They address consumer through things like gaming and Surface. They address enterprise through Windows, Azure, enterprise software, Dynamics. And of course, they're so big and so diversified that, they're a really great bellwether for sort of what enterprises and consumers are doing. And so, the interesting thing is Microsoft tracks itself across I believe it's 11 categories. And just to be clear, they were up or in the worst case flat in every single one of them this quarter. The only flat one was Windows OEM. Oh, I'm sorry. No. I'm looking at this backwards. They were up in every category. So there we go. Q2 22 up in every category. Another strong Azure quarter, Pat. Everyone marks the Azure number at 46%. But strong growth in Dynamics, strong growth in Office 365, strong growth in LinkedIn, server products. And I can go through the whole thing. But pretty much every place up and down. I think the most modest growth in the across the company's portfolio was Surface, which continues to be a little bit of a, I haven't quite figured that out there yet, Pat, but I've got a bit of a thesis I'm developing. I'm not going to share it yet on why Surface hasn't grown faster, but that even came in at 8%. The company just dropped $68.7 billion all cash, assuming they can get through regulatory to buy Activision and acquire another 400 million monthly users in a consumer space. That's another very bullish sign that they think consumer activity and spending is going to stay high. And of course, that they feel that their cash is better off invested right now than sitting in the bank. offering the company security. But across the board, Pat, you look at this company and you say, what's going on? Well, what I see going on is that, people are investing in cloud and they're investing in Microsoft. People are investing in ERP and CRM and they're investing in Microsoft. People are investing in search, in LinkedIn, and in gaming, up and down their whole portfolio, Pat. There's really nothing that you could look at and go, this is really eerie. And so, beyond just the kind of overall rhetoric that Satya Nadella might be the best CEO on the planet right now, you look at the performance and you say the performance doesn't lie. But the other thing that was probably important to point out is the company's guidance. They're saying they're going to beat again on revenue, somewhat significantly. Their entire range was above consensus. They came in at 48.5 to 49.3, and the consensus was 48.2. So they're expecting another possible $1 billion beat. I know billions become a small number somewhere along the line, by the way, like only $1 billion. And, they basically expect their margins to widen. So we were just having this whole talk, Pat, about how margins are going to consolidate a little bit for Intel because they're making all this CapEx investment. Well, Intel is actually starting to bear the fruits of more margin from all their infrastructure investment because, well, let's face it, it's the pivot to subscription. The pivot to subscription has been a huge winner for the company. So there's too much to talk about, and I don't want to spend any more time on trying to run through all this. I want to give you a little bit of oxygen here, but Pat, I just can't find much bad in Microsoft's result this quarter.
Yeah, hang on. Let me get my oxygen mask and put it on.
Are you telling me I didn't leave you anything? Are you telling me
I got to tell you, man, you machine gun down the list. No, you listen, with Microsoft and how diverse their business is, there's always room to talk through. And I want to put a little bit of color on a few items. So first off, Surface, right? They had back-to-back negative, big time, like negative 20% quarters. And, even I was maybe, questioning, hey, is this a supply chain issue or maybe is it a strategy change? I am absolutely 100% convinced it was a supply chain issue and it was short term. Nobody has told me this, but I'm also going to speculate that when it came down to their Windows partners getting parts and Surface getting parts, I think there may have been some deferment there. And I do think Surface is strategic, even though it was one of the least highest growing strategic businesses that they had. And I'm super excited to see what the company is bringing out in the future. Search and ads up 32%. Here's the company that isn't really noted for advertising, pretty much crushing it. Windows, 1.4 billion Windows DAO. Okay, think about that. That's nearly as big as iOS and Android, but it's a freaking PC. Okay. And if you want to check out more about Windows progress, Panos Panay had a blog you guys should check out for all of that. The other thing that was a new thing was talking about Azure Arc, which is essentially Kubernetes control layer to do multi-cloud. And that was a 3x growth. Now, I want the number. X growth doesn't mean a lot, but I'm hopeful because they threw that out there. We'll be seeing more on that. And I feel like, Google Cloud, Oracle Cloud, IBM Cloud is all in on multi-cloud. Azure's kind of in on it. And AWS is not in it, right? When you're the category leader in IaaS, why the heck would you lead with multi-cloud, which is essentially an off-ramp to your competitors? But and there are still challenges with multi-cloud, like security, single sign-on, networking, all that stuff, data management, but pretty interesting. The final thing I'll throw out there, security. They gave more depth to their security business than I've seen anywhere. And they threw out $15 billion annual business, 700,000 security customers, 45% year-on-year growth. Incredible. What's Microsoft's next big step here, Daniel? A couple things going on. Like, what's the next big step? Is it general consumer? Because we know they're absolutely going after gaming. They've been strong in gaming. They have 25 million Games Pass subscribers, but general consumer and gaming are two different things. Gaming is a subset of the general consumer, and I'd posit that Apple and Google are more consumer customers. So I'm looking forward to seeing Microsoft's play. I'm trying to brainstorm and think what they could do in the enterprise that they're not in. IaaS, PaaS, and SaaS, they're kind of in everything at this, and they're operating at planet scale. But exciting stuff. And then the final thing, and I know this isn't part of our discussion, Daniel, but maybe sometime in the future we can talk about big tech companies getting bigger versus room for smaller companies, right? These numbers are absolutely off the charts from Apple and Microsoft.
Yeah, they're so well run right now, and we have. You're not just talking about big tech getting bigger. We're really talking about this whole Linacon, FTC. How big can big tech get before it starts to become problematic for competition? And then, of course, these opposing forces of really happy customers that love being able to get everything from one place versus the harm it might do to allowing new and exciting companies to come into market and compete. So, yeah, let's put that on the docket for a week when we don't have 7,000 earnings and news to talk about, Pat. But yeah, we could definitely dive into that one. But we're still on topic 2, and we're now at the 6:10. 6:11 is our pace right now. So we probably got to keep moving.
Yeah, so let's cruise into IBM, coming off a post Kyndryl, and net IBM surprised on the top and the bottom. They had their highest revenue growth in 6 to 7 years. And, even though it's 6 to 7%, and that may not wind everybody up, it's a heck of a lot better than no growth, 1% growth. So I think IBM overall had a really good showing. A couple hot spots for them. I felt was cloud revenue at 19%, Red Hat revenue at 21%. Software at 8% may not sound interesting until you recognize that it's 89% gross margin, and then it looks really good. Consulting 13% at 27% gross margin. Infrastructure was flat. Infrastructure at IBM is really driven by Z, and Z15 has an extended cycle out there. So being flat and Z being on its last quarters of being sold before I'm expecting the new version to come in soon, I think is really good. And the great part about that is because most Zs are being used in cloud, being used with containers, or at least the new versions, it could get that cloud number up to 30%, which I think really makes for an interesting type of investment. And I had some people who were pinging me on, quote unquote cloud. What does it mean? But I'm kind of tired of this conversation with certain vendors, because listen, if I look at AWS, Microsoft, GCP, cloud is IaaS, PaaS, and SaaS. So IBM's hybrid cloud revenue is a combination of its software, consulting, and infrastructure. And their definition absolutely passes muster. I think we're more mature. I'm hoping we're more mature as a tech analyst industry, and even an investor industry, to understand that cloud doesn't just mean IaaS. It's a whole lot more. And we're going to talk about more cloud when we get to SAP.
Yeah, the definition of cloud is a moving target, Pat, and I think the market that long built its reputation on measuring IaaS is problematic. It's not actually just IaaS, PaaS, and SaaS. It's also all the services that encompass delivering cloud, and most companies have a combination of all those things. For a long time, we sort of looked at AWS as just IaaS, but they have all the things. They have PaaS. They have a lot of services. Of course, software is a smaller component of what they're doing, but I'm watching slowly things like Connect and Chime and other services build out that could easily take them into that direction. When you get to 16 billion a quarter, you're going to need to start to find diversified revenue streams when you're just selling primarily infrastructure. Data services, there's so many things. But IBM, look, this is a very simple assessment, Pat, and I know sometimes we like to make analysis tough because it makes us look smart, but IBM made a big decision to spin off GTS, Kyndryl, and most of GTS. It wasn't exactly GTS, but most parts of it, managed infrastructure services. It was a boat anchor for the company. It had been losing money and a disproportionately large percentage of the overall revenue and cost centers. So the company would have really good quarters like a Z cycle, like you mentioned, and could barely break even or 1% growth. We remember the Remedy declining revenue and earnings period when she was CEO. Krishna realizes that sometimes you have to break down the board before you can build it back up better. And so that decision's been pivotal. We've been hearing for the last few years about his decisions to go hybrid cloud. IBM not trying to compete directly with AWS and Azure was a very good decision because it's a different business model. But when it comes to comprehensive, highly regulated industries that have very specific needs from mainframe to edge, software and automation, IBM has a pretty comprehensive set of offerings and services to meet that need. They can do it, as you suggested, at a very high margin. And they've made some really good decisions. That $34 billion acquisition of Red Hat looks better with each good quarter. It still was a big number. It's still going to take a long time to get all that return. But we're seeing what companies are going for right now. And IBM didn't have a choice. I'm going to say that. They did not have a choice but to accelerate their hybrid cloud portfolio in a meaningful way. And Red Hat was instant credibility. That was instant credibility with a large subset of the hybrid cloud community. And that's starting to pay off, with the 20-ish% growth. Now that they have dropped the boat anchor, they've shown they can be more profitable to that mid-high single digits. That's not going to be enough, and the market's not going to be satisfied. So I'm going to say that right now. The market's going to want more. They're going to want more. They're going to want higher growth, faster growth. But this was a good sign that this quickly, upon the spinoff, IBM was able to deliver better than expected results.
Yeah, I give them congrats. Top line.
We have like a little button that we can press like Kramer does that cheers.
Yeah, exactly. So Daniel, let's move on to ServiceNow. That they just continue their hot streak.
Yeah, listen, we don't always cover ServiceNow, but they're one of the probably most interesting cases of tech is deflationary. Now, that's a bold statement here because as the economy grew, tech grew, but that's a natural byproduct of economic expansion. But a lot of people aren't talking about when they want to talk about tech wreck is they're not talking about the fact that technology is the underpinnings, whether that's semiconductors, that's software, that's infrastructure. If a company wants to become more efficient and more profitable with every dollar, they're not going to do it any other way than investing in technology. And one of those most important right now is going to be workflow automation. The idea that you can take a process, you can remove a lot of the excess steps out of these workflows and get more work done in less time in a subscription basis on an OpEx versus more CapEx, more humans, more people, more process, more paper, just makes a lot of sense. So ServiceNow, of course, sits in a position under CEO Bill McDermott to be in an opportunity for strength, whether it's as the economy contracts and rates go up and growth slows potentially, or whether we continue to boom and run hot. And so this quarter, the company showed strong growth. It showed 30% subscription revenue growth. It showed an improvement in how much on their performance obligation, which is important in SaaS, by 30%. They saw their large customers grow 52%. That's the over 1 million net new, 52% growth. And here's a great thing right now for a company like ServiceNow, 99% renewal. So in a SaaS ecosystem, to have almost zero attrition is just a tremendous outcome. The company's, doing, I believe they're forecasting over $7 billion in 2022 for subscription revenue. They've made some really big investments this quarter, hiring on and promoting from within, by the way. They promoted several of their top executives, Pat, this quarter under McDermott. And this was kind of an interesting one that I pointed out to in my research note is we see so many companies when they need new blood, they go outside. They don't promote from within. We recently pointed out, Pat, that Intel made some big moves with some exits and actually hired and promoted from within, which is impressive. For a company like ServiceNow, McDermott, back from his SAP days, was always really big on culture. And so he's bringing people up through the organization, and he really points to the fact that he wants to take his executives, train them up, develop them, and bring them up to become bigger contributors to the ServiceNow org. I like that. I think that's important. The other thing that the company is doing that's probably more important than ever is they're moving downstream from SaaS to PaaS. So everybody knows them for their workflow automation, but the Now platform, which has been rolled out, is becoming really big for the company. They've made some really big announcements. They've made some acquisitions. This quarter, they announced a big partnership with EY, a big partnership with DXC. And so, I think EY came out, Pat, and said they want $1 billion business alone with ServiceNow. So Ernst & Young, one of the biggest accounting and advisory firms in the world, is planning to build $1 billion practice on ServiceNow alone. So, overall, Pat, I think there's a lot of strength. The last thing I'll say is they now have over $1,350 million customers in the organization. So, as I started, and I'll finish this segment, tech in many cases will be deflationary for many people that are worried about what's going to happen to tech. I expect if the economy actually gets much worse, tech will actually surprisingly do well. Not all for great reasons. This is sort of that human automation, human machine sort of world that we're moving into. But companies like ServiceNow are building that kind of software that can really help companies be more successful in tougher economic circumstances.
Yeah, I don't cover ServiceNow as closely as you do, but I got to tell you, from an investment point of view, I look over the last year, it has not been a good investment. It's down. You would have lost money had you put money in. Heck, IBM, if I look over the past year, you would have made 16%. So to me, ServiceNow doesn't do a very good job at educating investors. They don't understand the value proposition, and I think they need a lot of help in getting this, getting their story out. And maybe, I don't know, maybe you and I having this discussion is part of that, but I just don't hear a ton of folks talking about the company. Now, I think part of that challenge is that they are a category killer right now, but trying to expand the base, right, into what they do, right? They're the best at IT and IT workflow, and they're kind of moving that into kind of this CX point of view, and they're trying to operationalize it. So and automate it, which I think is good. And maybe they can pull an Adobe or something like that, where they just keep kind of growing their category killer in one area and then grow. And we see company like Five9 in there as well, who starts off as a category killer, but then expands the definition, either makes acquisitions or goes organic. I put Zoom into that category too, right? They start as pretty much, Zoom started as a consumer tool, right? And then small business, and then enterprise, and then they get into events, and then they get into kind of contact center light. And I wouldn't be surprised if, they get into like a CX play. But good analysis on ServiceNow, and I think you've motivated me to learn a little bit about the company.
Yeah, and one thing I will point out, Pat, is you did say something that's true about the stock in the pullback. Overall, though, almost every single SaaS company, if you'd invested a year ago, you'd be down right now. There's not really an example of that. Having said that, if you'd have been in it for 5 years, the stock was at 5 years ago today was at $89. So it's at 551 today. So the horizon is always the proof point, and unfortunately, the last year to most tech companies' value has definitely done better. So you made a great point. The last year has not been friendly. It's just one of those things that I don't know how much of an indictment that is on any SaaS company, because Zoom was 550 a year ago and it's 150 now, and I think they're a good company too.
I don't think that's a good comparison because it's a COVID darling. Maybe Salesforce is a better comparison, but anyways, I'm not
arguing. I just mean it's an interesting. Yeah. It's a tough time horizon because of how badly tech has been beaten up over the last 3 or 4 months. So
yeah, and I'm not criticizing the company. I'm really criticizing more of the company's communications. It's not getting its value prop out there. But hey, let's dive into SAP here. And my gosh, this is the second week that we've talked about SAP here. Sorry, we keep dueling back and forth on that. And I think it's two things here. First of all, stock got hammered because of a risk about a perception of risk about cash. And I got to tell you, it is one of the weirdest things, particularly of a fiscally responsible company like SAP. People believed the company is worth a lot less because it was down 9% on the Frankfurt because of how it talked about cash in the future. And for a company like SAP, that's bizarre to me. Like, if Robinhood would make a statement like that, I'd be like, oh my gosh, something's going on there, something's going wrong. But I don't want that to overshadow what the company did in cloud. And I'll reiterate, SAP and cloud were not two statements that you would ever use together a lot in the previous 5 years. But the different approach that they took. So first of all, they do have some SaaS properties, particularly in ERP and payments. But the company leverages IaaS players to deliver its cloud, and hence it's a hybrid cloud play. And they're crushing it. Fourth quarter, cloud backlog up 32%, cloud revenue up 28%, SaaS and PaaS, like I said, up 37%, S/4HANA Cloud up 65%. So dare I say it, SAP is a cloud play, Daniel?
Well, you bring up a really interesting point. And like I said, we don't probably have to dig too far into this one because we talked about it last week, Pat. I mean, SAP is a very fiduciary, very thoughtful company. They're not necessarily known for moving fast. They've made some inroads into cloud. Some have been more successful than others. Remember, they still hold a big chunk of Qualtrics, but they did spin it off in order to, provide and unlock more value from that acquisition. They've made some interesting SaaS type acquisitions, companies like Ariba on the procurement side, companies like Concur on the expense side, that again, maybe the value you couldn't say has been fully unlocked, but they've definitely been making these significant cloud investments. But the biggest investment has been migration of the SAP S/4HANA to, the S4 migration to cloud. And there's been a lot of criticism that it's not fast enough or that it hasn't been easy enough. And that's why the company has rolled out Rise. And Rise with SAP is showing really strong momentum. I think they got 650 customers just this quarter and some very large customers. You're talking about a company with multiple hundreds of thousands of customers worldwide. And I think in their data point, Pat, they said the adoption of S4 at this point is 18,000. You have hundreds of thousands of migrations left to go. And they're working hard to streamline and make that more available. But it's a lift, and there's some significant work that companies are going to have to do. But as I see it, That's a huge opportunity. You look at, and I know these two companies hate being mentioned in the same sentence, but it would be, I'd be remiss not to take this opportunity. You look at the success that Oracle's had and how the markets really look very positively at the company, despite not always being the most popular. And I see some similarities. Now, they haven't embraced or offered any sort of public cloud the way Oracle has, but in terms of having that huge, steady, recurring customer database of licensed and cloud subscribers that they could migrate over to full cloud and SaaS solutions, these two companies have a really similar type of approach and opportunity, and that opportunity is very good. So as I see it, I think the RISE program is going to be successful. I think, right now the market is bearish, Pat, and they're looking for any reason to be negative. And so they found the reason here. But I think with the data SAP has, the customers SAP has, and a little bit of continued, ambition from CEO Christian Klein, and I think he's doing a lot of the right things. He's taking some of those Satya-like risks to flip the safe revenue to cloud revenue. I think if he can do it, there's a bright future.
Yeah, it's funny. First time I heard of RISE, I was like, oh, great. Okay, another transition program, marketing, blah, blah, blah. But it's actually it's made a huge impact, super impressive. Daniel, let's go to our last topic here. Bloomberg's Ian King wrote an article about NVIDIA quietly tiptoeing away from the ARM deal. What the heck's going on here?
Yeah, I mean, this is completely unverified right now by any executive on either side of the house, and neither NVIDIA nor ARM has come out, made any sort of actual statement. But it was sort of an interesting and timely notice that came out amidst some real strong tech selling, amidst the crazy Fed. You got a war going on. It's like, well, why not? This might not be a bad time to drop a bomb of news to maybe start to let the market down softly that this isn't going to happen. Now, Pat, between you, me, and the fence post, it's almost been a depreciating scale of approval in my mind that this would happen by day. Meaning, literally, if you take me back about 6 months ago, I was like 50-50. When it first happened, I was like, 60-40. I think they can get this done. And I think it was probably a couple months ago when we started to see the UK starting to push back harder, additional probes coming out of China, Europe, the US, everybody. We hear that I believe the FTC had planned to file a lawsuit. You just started to hear this stuff mount, and we all remember NXP and Qualcomm, and that didn't have nearly the actual public headwinds. And just as time kind of went on, you just started to get this feeling like this isn't going to happen. So while there's nothing verified from this news item, I can't help but feel that there's something there. And so I kind of think in the middle of all this sort of negativity and all these sort of macro events and COVID winding down and war in Ukraine, and I just think maybe it's not the worst time to start to kind of float that out there to say, hey, if we're going to be getting sold off, we may as well just take the whole hit right now. Because you've seen NVIDIA's fallen. And by the way, Pat, 3 months ago or so, when the first news of some serious litigation or legal challenges came out, it didn't actually ding the stock at all. The company was just charging forward. And so somewhere along the line, the market had to react. So I can't even tell you, by the way, if the reaction has anything to do with this news or just has to do with the general pressures that NVIDIA is under because it accelerated it so fast. But I do want to say I had a chance to talk to Barron's, and I did put out a research note about this. I actually don't think this will have as big of an effect on NVIDIA. I think this is a tough thing for ARM, though, because SoftBank's in a tough place. I believe we just were talking about Maurice Leclerc, I believe is how you say his name. COO just left this morning. This deal was a fairly significant one for the company to try to get something back from a big investment that really hadn't returned very, very significantly. And SoftBank's been under a ton of pressure. There isn't really a logical landing. We're hearing IPO potentially for ARM. ARM I think, needs a big injection of R&D and support. And that's what they were going to get from NVIDIA. We heard things, Pat, like consortiums. We heard, ideas like that from Cristiano Amon, from Qualcomm. We've heard the idea that maybe some of these other companies building on ARM. But ARM right now is basically enabling a series of the world's largest companies, from Qualcomm to Amazon and Microsoft, to build chips. I'm just not sure how much it's enabling the rest of its licensee ecosystem. So whether NVIDIA would have made that better or worse wasn't clear. But Pat, it's not official. Nothing official happened this week. But mine, I'm like at 1090 now or less in terms of this deal getting done.
This is so target rich and conversation rich. It's not even funny. I mean, it talks everywhere. Let's not forget that Qualcomm was being attacked by every regulatory arm out there. And you know what? Guess what? They found their way out, right? So just because NVIDIA is getting some scrutiny, to me, doesn't mean, oh, it's dead. There have been companies, I mean, heck, Intel's still fighting an EU battle on its fine it got in 2009. So that doesn't score a lot of points with me, or doesn't carry a ton of weight. But I was excited about ARM and NVIDIA coming together for the competition it would bring into the x86 market. We have a PC market that is 98%. Well, I guess I have to look at the new MacBook stuff, but let's just, and it's,
those numbers are pretty good, by the way.
Yeah, let's just say the PC market's 93% x86. The server market is 95% x86. I really wanted to see NVIDIA and ARM come in and just pour a tremendous amount of investment into both those markets. And also, I don't want anybody to be misled by who had an issue with this. Regulatory bodies may be writing the press releases, but this is absolutely NVIDIA's competitors at work here, undermining this, okay, and bankrolling this effort to derail it. Because in the end, Daniel, and this is going to sound harsh, IBM's biggest customers prefer a weakened ARM, okay? Because that means that they can provide value add on top of what ARM did, kind of like it did before.
You said IBM's biggest customers. I'm assuming you meant Intel.
Sorry. ARM's biggest customers.
Okay.
Yeah. So they can put their value add on top and they can innovate. They don't want ARM to be too strong. And on the SoftBank piece, look at the investments that ARM made since it went into SoftBank. Big core, very big core for smartphones and PCs. 2 data center cores at different levels of performance. A full automotive ASIL certified automotive stack, and all the IoT investments they made. So, and you don't just make those investments once and then stop. You have to continue those. So ARM will have to probably have to raise prices to be able to feed that beast. Now, it's a private company, so I don't fully understand. I don't know all their financials, but all I know is that SoftBank invested. And ARM is either going to have to capture revenue for that R&D at a higher rate, or get out of those markets. Not out of the markets, but doing the value add that they're putting in, which a lot of their customers do appreciate. So as far as a consortium, can you imagine Samsung, Qualcomm, Apple, and AWS and Azure trying to come up with an agreement on a specification for, an ARM v10 specification? It'll be like the IEEE, which takes like 5 years to come up with a decision. And anyways, this is target rich, buddy, and we're going to be talking about this a lot. And by the way, we went long. We appreciate everybody hanging in there. Really motivated to be back. Daniel, I love that hat. 6.5 Summit coming up June 7th, June 9th. Last year we had 50 speakers, 16 CEOs. We're going even bigger this year and better. We are almost ready to make it official and talking about the tracks. But hey, I want to thank everybody for tuning in today and want you to have a great weekend. Tell me what you liked on Twitter. Tell Daniel what you didn't like, and suggestions to all of us. Have a great one.